cut through the confusion, understand the crisis, prepare for the future. Decoding Rickards. The collapse of Silicon Valley Bank, SVB, was a seismic event that sent shockwaves reverberating throughout the financial industry and beyond. Understanding the intricate web of factors that contributed to SVB's downfall is essential not only for dissecting the immediate implications for the banking sector, but also for comprehending the far-reaching economic repercussions and extracting valuable lessons for the future. Silicon Valley Bank, founded in 1983 and headquartered in Santa Clara, California, had long been hailed as a beacon of innovation and entrepreneurship, serving as a pivotal financial partner for the tech community in Silicon Valley and beyond. Its specialized focus on providing banking services tailored to the unique needs of technology startups, venture capital firms, and innovative enterprises set it apart from traditional banks and earned it a reputation as a trailblazer in the industry. However, beneath the veneer of success and innovation, SVB grappled with a myriad of challenges and vulnerabilities, both internal and external. Like many financial institutions, SVB faced relentless pressure from a rapidly evolving regulatory landscape, heightened scrutiny from regulators, and increasing demands for transparency and accountability. Navigating this regulatory maze while simultaneously striving to deliver innovative financial solutions to its clients proved to be a delicate balancing act for SVB. One of the critical factors that contributed to SVB's downfall was its heavy reliance on short-term funding sources, such as overnight loans and wholesale funding markets. While these sources provided the necessary liquidity to support SVB's lending activities and operational needs, they also exposed the bank to significant refinancing risk, especially during periods of market turbulence or uncertainty. The abrupt onset of the COVID-19 pandemic served as a stark reminder of the perils associated with such funding models, as global financial markets were roiled by unprecedented volatility and liquidity shortages, exacerbating SVB's funding challenges and amplifying its vulnerability to market shocks. When the Federal Deposit Insurance Corporation, FDIC, takes receivership of a failed bank, it signifies a serious financial crisis. The FDIC has the legal authority to take control of a bank's assets and liabilities when the institution can no longer meet its obligations to depositors and creditors. This drastic step is taken to protect the financial interests of customers, minimize disruption, and prevent further harm to the overall economy. The creation of bridge banks is a temporary measure designed to facilitate the transition of a failed bank's operations to a new owner or to manage an orderly wind-down. These bridge banks operate under FDIC supervision, providing customers uninterrupted access to their funds and ensuring that essential banking services continue without disruption. The purpose is to provide stability during a chaotic period and give the FDIC time to find a long-term solution for the troubled institution. When the U.S. government invokes systemic risk powers, it highlights the severity of the situation. This authority is used only in extreme cases when a bank's collapse has the potential to trigger a domino effect and destabilize the entire financial system. In this instance, the government stepped in to fully protect all depositors, even those with accounts exceeding the standard FDIC insurance limit of $250,000, signifying the magnitude of the potential crisis and the determination to prevent widespread panic. Taking receivership gives the FDIC control over the complex tasks surrounding a failed bank's finances. The FDIC must evaluate the bank's loan portfolio, assessing the likelihood of borrowers repaying their debts and determining how to collect or sell off those loans to recoup losses. Another key responsibility involves assessing existing contracts related to derivatives and other financial instruments. The FDIC needs to weigh the benefits and risks of honoring versus terminating these agreements. The FDIC must untangle the web of financial obligations and assets tied to the banks, meticulously navigating legal and financial complexities to protect stakeholders as much as possible. Furthermore, SVB's business model, which revolved around catering to the financing needs of high-growth early-stage companies in the technology sector, proved to be both a boon and a bane. While this niche focus had historically provided SVB with a competitive edge and fueled its impressive growth trajectory, it also rendered the bank susceptible to the cyclical nature of the tech industry. As the pandemic-induced economic downturn took hold and uncertainty gripped the markets, SVB found itself grappling with mounting loan defaults, deteriorating asset quality, and heightened credit risk within its loan portfolio, posing significant challenges to its financial stability and solvency. Moreover, SVB's deep integration within the broader tech ecosystem amplified its vulnerabilities as the fortunes of the bank became intricately intertwined with the ebbs and flows of investor sentiment, market dynamics, and technological trends. With tech valuations experiencing wild fluctuations and investor confidence wavering, SVB's loan exposure to the tech sector came under intensified scrutiny, with concerns mounting about potential credit losses, asset impairment, and loan delinquencies. In addition to these fundamental weaknesses, SVB also faced challenges related to regulatory compliance, governance deficiencies, and inadequate risk management practices, further exacerbating its precarious situation and undermining investor confidence in the bank's ability to weather the storm. Reports of lax oversight, internal control failures, and risk management lapses raised serious questions about the effectiveness of SVB's risk governance framework and the robustness of its internal controls, casting doubt on the bank's ability to manage its operations prudently and navigate the challenges confronting it effectively. The collapse of SVB sent shockwaves throughout the financial industry, triggering a cascading series of events that reverberated across global financial markets, accentuating the interconnectedness and interdependencies within the financial system. As investors and counterparties scrambled to assess their exposure and mitigate their risks, liquidity dried up, market volatility soared, and contagion spread to other financial institutions, exacerbating systemic risks and destabilizing the broader financial ecosystem. In response to SVB's collapse, regulators moved swiftly to intervene, assuming control of the bank and implementing a series of remedial measures aimed at stabilizing the situation, restoring market confidence, and safeguarding the interests of depositors, creditors, and stakeholders. However, the fallout from SVB's collapse extended far beyond the immediate regulatory response, prompting a broader reassessment of risk management practices, regulatory frameworks, and industry norms within the banking sector. Policymakers and regulators faced mounting pressure to enact comprehensive reforms aimed at addressing the underlying vulnerabilities and systemic weaknesses that had contributed to SVB's downfall, while simultaneously bolstering the resilience and stability of the financial system. Efforts to enhance regulatory oversight, strengthen capital requirements, improve risk management standards, and enhance transparency and disclosure requirements were prioritized as policymakers sought to rebuild trust, restore confidence, and fortify the financial system against future shocks. The lessons learned from SVB's collapse served as a sobering reminder of the fragility and complexity of the modern banking industry, underscoring the imperative for continuous vigilance, proactive risk management, and prudent governance. As the banking sector grappled with the aftermath of SVB's collapse, stakeholders across the board were forced to confront uncomfortable truths about the need for fundamental reforms to address systemic vulnerabilities, enhance resilience, and safeguard financial stability in an increasingly interconnected and dynamic global economy. Thanks for watching. If you found this helpful, please give the video a thumbs up, and for more content like this, hit subscribe button and bell icon.